Hi, everyone. Welcome, welcome. Welcome, one and all. How is everyone? Is everyone doing well? I can see your messages, guys. So feel free to send them in. How are you guys? I'm good. I'm doing very well. Thank you. Doing very well. Thank you, everyone, for joining. So as mentioned, this is Virginia Webinars. This webinar will be focused on the importance of cash flows. Okay, so just to confirm, everyone can see my screen, yeah? If you could please just send me a message. You can hear me, you can see me, and you can see my screen, yeah? The trifecta. All good? Wonderful, wonderful. Great, guys, great. So without further ado, let's get started. So before we begin on our topic at hand today, let me take a moment and introduce who we are. We are the Virginia Institute of Finance. We are a financial training and consulting firm originating from the US, more specifically outside of Washington, D.C. in the Northern Virginia area, hence the name Virginia. That's where the name comes from. We have a regional office here in Dubai. That's where I'm based. And we are in the process of opening an office in Riyadh. So in the future, we will also be based there. So we provide trainings across 4 verticals. The first vertical, as the name implies, is the finance, investment, accounting, treasury vertical. This is where we have all of our financial analysis courses, financial modeling courses, treasury courses, and so on and so forth. Our second vertical deals with data analytics. Everything from the Microsoft Office certifications, ranging to Power BI, Power Query, and everything in between. We also have some flagship courses, if you will, within our data analytics arm that are essentially Excel courses, but that's put very simply. They are business reporting courses using Excel. Wonderful, wonderful, wonderful courses, highly recommended to everyone. And then, so moving on to our third vertical, it's our internal governance, internal controls, fraud, corporate governance, risk management vertical. And finally, we have our specialty behavioral and technical courses. This is where we offer trainings for very popular certificates within the PMP and the CAPM. So I haven't introduced myself yet. My name is Faritz, and I'm a senior financial consultant with Virginia. My background is heavy in finance, investments, financial modeling, valuations, very, very repetitive. My undergrad and my graduate degrees were both in finance. And I am a AFM holder, a financial modeling holder, advanced financial modeler holder by the Financial Modeling Institute. You can find a complete bio of myself on our website. So before we begin talking about cash flows, I just want to take care of a few housekeeping issues. So this webinar will be recorded. You will receive this recording via email after this webinar takes place. So within the next 24 hours, expect to receive this webinar emailed to you directly with the email you registered with. You can rewatch at any time. We post all of our webinars on our website. So feel free to check out elearning.viftraining.com or head over to our website and you can find the e-learning section from there, from our homepage. So we will have a Q&A set. I am happy to answer any questions you may have, as long as they are relevant to this course. If you have any other questions, feel free to email me. Feel free to reach out to us, to anyone at the firm, or reach out to our office if you have any questions about Virginia itself. But for this webinar, let's try to keep the questions more related to our topic at hand. I am happy to stop and answer questions roughly every 10 minutes, just depending on how many questions are being submitted. And if you have any technical issues at all, you can't hear me, you can't see me, send me a message. I'll do my best to take care of your issue as best I can, of course. And finally, at the end of the webinar, you will receive a certificate for attendance that will be sent with your copy of this webinar. So if you are looking to see any of our other webinars, we have webinars ranging from topics ranging from Power BI to Power Query to financial modeling to financial to valuations to really a whole bunch of stuff from financial analysis and so on and so forth. Take a look at our website at www.viftraining.com. They are all free. There's no charge to watch them. So if there's any topic that you might be interested in or anything like that, feel free, check out our website. We have tons of webinars, pre-recorded webinars that we have actually held in the past. Take a look at our schedule. If there's anything that may interest you, you may want to attend, feel free to check it out. Also, we have a wonderful library of e-learning courses. These range from our business reporting using Excel to Power Query, Power Pivot, etc., and so on and so forth. We have financial modeling e-learning courses. We will be releasing financial analysis e-learning courses. There's really a ton of very beneficial stuff for you there. So without further ado, let's talk about why we're here, yeah? But before that, I have a question for you guys. A very important question, I might add. If you could only choose one financial statement to assess the financial health of a company, what statement would you choose? So I'm going to release the poll now, okay? Everyone can just answer, okay? It should pop up on your screen now. So please feel free to answer. Let's see how everyone is responding, okay? So again, if you could choose one financial statement to assess the health of the company, of any company, what statement would you choose? All right, I see the polls coming in. Good, everyone. Keep them coming, keep them coming. Okay. How about 10 more seconds, and then we'll go ahead and see our solutions, yeah? Okay. All right. Just about. No one else? No one else? Okay, there we go. Okay. So it seems that the majority of you are actually correct. So the majority of you have said the cash flow statement. So let's take it from the top. The four options are the income statement, the cash flow statement, balance sheet, and the equity statement. So this was a little bit, I kind of put you in. Well, if you looked at the title of the course, you probably had an idea of what statement I was going to be asking about, right? So yes, the answer is the cash flow statement. It seems that the majority of you have answered it correctly, but for those of you who have not, that's okay. I'll go ahead and explain why the cash flow statement is so important. So at a high level, let's just talk about the four statements. The first one is the one that everyone knows about, the income statement. The income statement does what? It tells you all of your profits and all of your expenses, right? All of your sales, basically, that you've made in the period, and all of the expenses that you had to pay during that period, right? So to put it simply, if I'm a bookstore and I sell books, my sales will be recognized based on the number of books I sell, and my costs will be everything in the period that have to do with the selling of the books to my expenses for the operations, right? Very nice. That makes sense, right? This is what we normally think about when we think of business: sales and expenses. Selling the book, I sold the book for $20, and the book cost me $8 to purchase, right? So my expense is $8. So I've profited $12. Now, on top of that, I also have other expenses. I have salaries for my staff. I have rent expense. I have insurance and all of these other things that will reduce my profitability, right? So that's the income statement in the most simple of all examples. Okay, wonderful. Now let's talk about the balance sheet. So what does the balance sheet tell us? It tells us what we own, so what we have, and what we owe, right? Very simple. It tells me my cash, my fixed assets at the most high level, and then it tells me what I owe, like my debts, right? Wonderful. So if I can figure out what I have and understand that from what I have to pay back what I owe, my debts, the remaining amount will be my ownership, right? And that's presented as equity, or the retained, the shareholders' equity within the balance sheet, right? So the income statement tells me what my profit is, and the balance sheet tells me how much I have and how much I owe, and then the residual value, if you will, that I have, right? So if I have assets in cash of $1,000 and I have debts of $100, my position, my equity value, my shareholder value is $900, right? 1,000 minus 100, I'm down to 900. Makes sense. Okay, so one tells me how much I'm profiting. The second one tells me what I have. Okay, and the equity statement, nobody chose the equity statement, but the equity statement just tells us the equity portion of the balance sheet, right? It just describes in further detail the movements within that. So that one doesn't have any, that one is a good call. Nobody chose that one because that one gives you very limited information, right? So now back to the question at hand. The answer is the cash flow statement. But why is the cash flow statement so important? Well, I want you to keep this thought in your mind because I'm going to answer this question throughout this webinar, okay? If I have not convinced you that the cash flow statement is very important, or most important by the end of this webinar, I will, actually, I'm not going to make any promises, so let's just continue from here, okay? So let's talk about the cash flow statement. So the cash flow statement does what? The cash flow statement tells us what has happened from a cash flow perspective over a period of time. So my cash flow statement is similar to my income statement in that my income statement tells me my profits and my expenses. However, the cash flow statement essentially takes your income statement and makes adjustments for anything that's non-cash. Because at the end of the day, what I care about as a business owner, as an investor, as anyone analyzing a company, is the cash flow, right? Because I want you to take a moment and think about something. If I have bills to pay, and we all have bills to pay, businesses, corporations all have bills to pay, can I pay my bills with accounting profits, or do I need cash to pay my bills? Which one? Now, some of you are probably thinking, Farid, what's the difference? Why are you telling me profits versus cash? Aren't they the same thing? Well, no. Our profits are essentially accounting terms, right? I can have a wonderful, net profit on my income statement. However, I may not have collected it in cash. Think about it for a second. Businesses around the world work on credit. So when I make large purchases as one business to another business, I will very rarely, or normally I should say, I will be given some sort of 30-day credit terms, right? So if I have not received my credit term, my payment in cash up front from the customer, they still owe me money. So that means that although I have recognized revenue because I've sold the product, they haven't paid me for that purchase yet. So if I think about it for a second, my income statement is nice, it's wonderful, it tells me about my profitability, but my cash flow statement will actually tell me how much cash is coming in and how much cash is going out. So let's just talk a little bit more about the cash flow statement, but I want to look at it from a little bit of a different perspective. Okay, I want to look at it from the 3 pillars of finance. Now you're probably asking yourself, what are these 3 pillars? Well, if you look at the bottom of the screen, the 3 pillars are the operating activities, the investing activities, and the financing activities that any company can do. These are also the three types of financial management decisions a company can make. And these are not coincidentally, I'm having trouble saying the word today, related to the cash flow statement. So when we think about the cash flow statement is made up of three parts: the operating activities, everything that has to do with the company's operations; the investing activities, where this is where all of the investments the company makes will be presented. So any internal investment or any external investment. And then finally, the financing that the company may take. So if the company is going to borrow money or if the company is going to repay money, this will show up here. Okay? Now, what I want to do is I want to map these three activities to the other two financial statements, the income statement and the balance sheet. So how am I going to do that? Well, let's take a look at it together. So simply put, and this is the simplest of all examples, the operating activities of the cash flow statement. This is how the cash flow statement begins. We start with the operating activities, then we have the investing activities below, then finally we have the financing activities, right? The net effect of the three gives us our cash flow. So if our operating activities it ends up being a positive 10, our investing activities is a -2, right? And because we spent money, and our financing activities is a -4. Well, 10 minus 2 minus 4 is 4. So we have a +4 in terms of cash. Okay. Now that we have that in our heads, let's just hold that for a second and let's map these three activities to our income statement and our balance sheet. Okay. So the way our cash flow statement works is simply like this. What we're doing is we are taking our income statement and our balance sheet and we are trying to figure out what has actually happened in terms of cash. Do I have more cash or have I spent cash? And that's it. That's pretty much what I'm trying to determine. Okay. So the operating section of the balance sheet of the cash flow statement works like this. We take our income statement and we make any adjustments for the non-cash items. So any non-cash sales, any costs that we have not paid yet, we make those adjustments. Okay. So a couple of very, very, very common adjustments that we make have to do with depreciation, and they have to do with end of service benefits, as well as our working capital changes, right? And our working capital changes we'll get into later. But that's just something to keep at the top of your head. Now, the next thing that so with that, we also make adjustments for the current assets and current liabilities section of our balance sheet. So our operating activity maps to the income statement and the current portion of the balance sheet. All right, wonderful. Next, when we talk about the investing aspects of a business, we are actually mapping to the non-current assets that the company has on its balance sheet. So any investment the company makes in land, in buildings, in machinery, in furniture and fixtures, etc., even outside investments is listed here. So the non-current assets portion of the company's balance sheet is reflected on the investing activities of the cash flow statement. So if I want to understand what happened in between the periods between last year and this year on my balance sheet, I can see a cash movement on my cash flow statement. Now, by default, the remaining part of my balance sheet, my equity section and my non-current liabilities, has to map to my financing activities. But this is pretty intuitive, right? If I think about it, how can I fund a business? Well, in one of two ways, through debt or through equity. My debt is my non-current liabilities, and my equity is my shareholder capital, my investors, the owners of the business. And that is exactly how the three activities of a cash flow statement map to the rest of the financial statements. Now, something else I want to mention, I don't need if I'm not provided a cash flow statement, I can actually go back and create my own, because the cash flow statement is the linking between the income statement and the balance sheet. So if I have one income statement, again, the income statement covers a period. So if I have an income statement for the year 2021, and it covers from January through December of 2021, and I have two balance sheets, the balance sheet in January 1st, and the balance sheet ending the income statement, December 31st, I can go ahead and recreate my own cash flow statement. And in fact, most private businesses, as I'm sure we have some analysts here in attendance, will not give you all three statements. Sometimes they give you just a profit and loss statement, and they give you a balance sheet, and you have to go out, and the analyst has to go out and figure out what the cash flows look like. I'm sure we have some people here. If you have, you know how arduous of a task that can be. If you haven't, you have not seen anything yet. So let's move on, and let's just talk about some examples for the three cash flow statements, or for the three cash flow activities, okay? So the first one, like we said, has to do with operations. So we have, in our cash flows, two forms of cash flows: cash inflows and cash outflows. The inflows is exactly as it sounds like. It's cash entering our pockets, okay? The outflows is any cash leaving our pockets, okay? Very straightforward. The cash flow statement is the most straightforward statement, if you ask me and if you ask others, in relation to the other two primary statements, the income statement and the balance sheet. Because what you see in the cash flow statement is what you get. The ending cash is actually your ending cash number in your bank account. You should be able to reconcile that there. So let's just talk about a few of the activities. So within our operating activities, we have cash inflows. So what would be an inflow from the operations? Now think back. The operating activities maps to the income statement and the current portions of the balance sheet. So with that in mind, any cash that I collect from my customers is a cash inflow from operations. Makes sense, right? I have sales and it's an operating activity. Any cash paid out to my employees or my suppliers for salaries or for expenses is a cash outflow. Intuitively, that makes sense. So if I want to basically look at the operations of the business and I want to determine how much cash is the operations actually generating, all I have to do is look at my cash flow from operations, and that will tell me whether my operations, whether my business is making cash or losing cash. Because if it's making cash, that's a very good thing, because I have other things I have to pay for. I have to pay for my investing activities, right? Which a few examples of an outflow would be acquiring assets, right? Building bigger factories, expanding my machinery, buying an office, etc. Whereas an inflow would be the exact opposite of that. It would indicate that I'm selling assets. Maybe I'm selling some fixed assets. Maybe I have some machinery that I decided to sell. Maybe my capacity is too high versus what I'm expecting. So I'm trying to get some cash for some capacity that I will not be using, and so on and so forth, right? So I need my operating activities to be as positive as possible, because I have to pay for my investments. Now, if my operating activities is negative, right? If I'm not actually making a positive cash inflow, net inflow from my operations, and I still have to pay my investments, well, I can go to my financing activities and try to get some cash from them, because my financing activities is synonymous with my funding. And remember, we said we can fund in two ways: debt or equity, and that's it. So if I take with my financing activities, an inflow would basically be I am issuing debt or I am bringing in more investors. Okay, think about it. I'm issuing debt because cash is entering my pocket, which means it's a positive inflow. An outflow would be if I am paying back some of that debt, right? Because cash is leaving my pocket. So again, this is how the three activities basically work. They're very straightforward. The only thing that you have to keep in mind is, what does the activity I am looking at relate to? And if you can determine that, you can figure out whether the item will be a cash inflow or a cash outflow without a lot of detail. Okay? So now that we know what the cash flow statement does, we know the three pillars of finance, we know how the cash flows of the cash flow statement relate to the other two statements, right? How they map, and we know what the activities indicate for each of the three cash flow activities. Let's talk about the actual relationship between these financial statements, okay? So what you see on your screen is three statements: an income statement, a balance sheet, and a cash flow statement right in the middle. I have presented here a very high level relationship between the three financial statements. Now, this is not an all-inclusive linkings between the three. However, this does capture a lot of the high level relationships between the statements, okay? So let's just start with the income statement. Like we said, the income statement tells us our revenues or sales and reduces our cost of sales and any other expenses we may incur. These include interest expense, end of service, and zakat and taxes. And then we have our net income, okay? Now, our balance sheet lists all of our assets and all of our liabilities. And finally, our equity. And the most important piece of our equity is our retained earnings, okay? This is important for one reason, which I'll mention in a second. So our statement of cash flows has three activities, as we discussed. Our operating activities are, resulting in our net cash flow from operations, our investing activities, and our financing activities. All right, now that we know what the three primary statements are, let's see how they relate. Well, our revenues has to do with our working capital. Now, the changes in our working capital are changes in our accounts receivable links to our changes in working capital. So our revenues, our cost of revenues, and our expenses actually all link to the changes in working capital, okay? And these changes in working capital affect the current portions of our assets and liabilities. So primarily our accounts receivable, our inventory, and our accounts payable. Remember, this is a high level. If we were to try to map all of the relationships, we wouldn't be able to interpret any of it because they would go back and forth, right? So moving on from there, our net income links to two places. The top of our statement of cash flows, it's the first item on our operating activities, and it links to our retained earnings, okay? This is the only relationship that we have that links our income statement directly to our balance sheet. Okay? It's essentially the plug to our balance sheet, if you will. Now, moving on, we have other relationships as well, primarily with our long-term assets, our investments, our property, our equipment, and these balances have a relationship with our capital expenditures. So the more we spend on investments, the higher our balance sheet balance of our property and equipment will increase, right? And again, we have the same relationships with our debt and our dividends. So if we borrow money, our balance sheet debt will increase. If we pay back money, it will decrease. And dividends gets paid out of retained earnings, although it's a cash effect. And finally, to tie everything together, the closing cash balance on our statement of cash flows is the plug to our balance sheet. All right. So this is a very high level, really high level relationship classifications between the three statements. However, if you can understand the mapping that we discussed earlier, this makes a lot more sense. So now I have another question for you guys. All right. I would like to know, let's see. How do I get the next poll? Here we go. So I just launched a poll. I want to ask, what section of our cash flow statement do we add back the non-cash expenses under? Now think about it. Non-cash expenses. Where do we have a lot of non-cash expenses? Okay, the key non-cash expenses. We talked about them, right? So do your best, guys. Let's see. Let's see what we see here. Or let's see what we end up determining between the group. All right, all right. It looks like half of the team has voted. Come on, guys, let's see the other half take their votes. Where do we add back the non-cash expenses? Now think about it. Where are we adding them back from? The income statement, right? Of course. So where does that effect show up? Almost there. I think there's a few more people who haven't voted yet. All right, guys, let's just take 10 more seconds. Just take a shot, guys. Take a shot. You don't lose any points for a wrong answer, okay? All right, there we go. Okay, so let me share the results with you. It looks like most people got it right. The answer is cash flow from operations, okay? Now, some of you have said cash flow from investing, and some of you have said cash flow from financing. And I can see why you would think that, but we want to keep in mind what we're talking about. When we talk about adding back the non-cash expenses, we are adding them back from what? Well, we're adding them back from the income statement, right? Because if you recall, we identified how the income statement has a lot of holes. There's a lot of items presented there that may or may not be cash. So if you recall, like depreciation, end of service benefits, and any adjustment in our sales and cost of goods sold and OPEX, right? Maybe those things didn't actually translate to cash. So our net income, although is a very important number, has a lot of gaps. So what we do is we take, and if we go back and just take a look at our income statement here, the first thing that we're doing under our operating activities of our cash flow statement is we are starting with net income. Now, why do we start with net income? Let's just think about it for a second. Like we said, net income has a lot of holes. There's a lot of things embedded within this net income that may or may not be cash. The revenues, they don't necessarily mean that these revenues figures were collected in cash. Cost of revenues. Again, the cost of sales doesn't necessarily mean they have been paid for in cash. They may still be on credit. And our expenses and costs, same exact thing. It does not necessarily mean that these items are all cash, right? I may have a rent expense on my income statement, but I may have paid for my rent for a year, a coming year, maybe 3 or 4 months ago. So maybe this month I don't have the rent, this rent expense I'm incurring or I'm presenting on my income statement. Maybe it's the cash has already been paid previously, right? So that's why that's why we add back these non-cash items to the operating activities, because I want to adjust for this net income that has a lot of holes, that's not necessarily cash, and I want to get a true cash number from my operations, okay? Now, there are items that may be added back within my investing activities that are non-cash, and my financing activities as well. But when we talk about adding these items back, we are talking about the operating activities, because the operating activities gives us the true cash flow of our operations, okay? Well done, guys, well done. So moving on, let's talk about how we read and interpret a cash flow statement. So again, let's just reiterate the 3 activities of the cash flow statement. So we have the operating activities, the operating activities, the investing activities, and finally the financing activities. Within them, we have many things that happen, right? And the activities determining on what's happening are classified as either cash inflows or cash outflows. Okay. Now, just because you see a cash outflow in one category does not mean that's a bad thing. Just because you see a cash inflow in another category does not mean it's a good thing either. Again, it depends on the activity that you're looking at. So let's just take a look at the high-level items again, and I think we can all agree that some of these items are good versus the other ones probably not so good, right? So within our operating activities, the simplest of the activities, our operating activities has to do with the normal operations of the business. if we sell goods and services, any inflow from the sale of goods and services is a wonderful thing. We've made sales, right? We've collected that sales in cash even. Any outflow is expected. We have to pay for those products that we resold or that we sold. We have to pay for our operations. We have to pay for our taxes, right? So these items are typically classified as cash outflows. Now, the net effect of all of my cash inflows and all of my cash outflows within my operating activities results in my net cash flow from operating activities, okay? So all I'm doing is I'm taking those inflows and I'm subtracting out the outflows, right? If I was going to look at this on my cash flow statement, these would be positive and all of these would be negative, right? And that's it. Remember, we said the cash flow statement tells us exactly what's going on the statement itself. Now, looking at the investing activities. Investing activities means that I'm putting investment into my business, whether I'm adding capacity, such as buying more machinery, buying more equipment, and so on, or I am making an investment, right? Maybe I'm making an investment in stocks. Maybe I'm buying part of another business. Maybe I have a joint venture that I have to invest in, right? It could be any of these things and many more. Now, so logically speaking, intuitively speaking even, it makes sense that my investing activities should predominantly be negative, right? I should be paying money out of my pocket to keep my operations running, to keep my machinery, my equipment maintained, well equipped, in order for them to continue to produce my goods that I'm selling, right? Now, let's flip that. What if I have a positive investing activity? A net cash flow from investing is a positive number. Well, that can only mean one of a couple of things, right? I've either sold an investment, right? If it's a financial security, that's great. Maybe I've made some money there. Maybe I've received a dividend on my shares or anything like that. But the other option, and depends on, and I'm not sure whether it's a good or a bad thing. It really depends on the situation, but the sale of my fixed assets. So what if I've sold some of my machinery? What if I've sold some of my fleet, my vehicles? Is that a good thing or a bad thing? Well, it can go either way. If I had extra capacity, if these vehicles were already near the end of their useful life, and I was able to basically, achieve some sort of gain, then maybe that's a good thing. But if I'm selling assets, important assets that I need to produce my sales, then that's not a good thing. That's a very bad thing, right? I think we can all agree. If I'm trying to produce 1,000 units of books or of widgets, the simplest textbook example, widgets, and I'm selling some of my machinery that produces my widgets, well, I don't think I can produce the same amount of sales as I could previously, right? Again, it all depends, but I'll leave that to you to determine on whatever business you're looking at. And finally, my financing activities, which again is we've gone over it already pretty well, right? My financing activities, an inflow would be if I'm borrowing money. So I'm receiving the cash, and an outflow would be if I'm repaying that cash, right? Ideally, I would want to see my financing activities to be negative, right? You're probably thinking, why would you, Farid, what are you talking about? Why would you want it to be negative? Well, simply put, I have to pay my shareholders something as well. My shareholders, when they invested in the business, they expected to receive some money in the future, whether through a sale of the business itself, or more probably in the form of dividends. So they expect, as the business does well, they would receive some sort of dividend payout, right? Some sort of bonus for ownership, if you will. And that should be negative, at least slightly negative in the grand scheme of your cash flows. So let's just take a look at, we've been speaking very hypothetical, right? From probably this entire presentation. Let's take a look at actual statements. So what you see on your screen now are the cash flow statements, or the cash flow statement for SABIC. So as you can see on the left, this is SABIC's financial state. Their cash flow statement begins with their operating activities, and the very first item is the income before zakah and income taxes. So this is essentially what they did here is, and this is very commonly done, rather than starting with net income, the company will present income before zakah. This is because the zakah that they have to pay, that they pay in cash, is not going to be the zakah that they present on their income statement. So even that number isn't exactly true, right? It's more of a provision than anything else. So they've just saved us the headache of having to adjust. So they gave us income before zakah, which is great. Then they made all of the adjustments for the non-cash items that's embedded within this income before zakah. So let's take a look at what they did. The first item was about 12 million riyal, or I guess this is technically billion with a B, of depreciation. Now this is a big non-cash expense, and now it's gotten added back to our income before zakah. And then they removed all of these items, all of these cash and non-cash items that basically that we reach to our changes in operating assets and liabilities. Okay. Now this is where we're making the effect of things like the increase or decrease in inventories, increase or decrease in trade receivables. Basically, do we have more money outstanding, more sales outstanding, or are we collecting, and so on and so forth. Okay. Now, finally, at the bottom, they've presented the actual finance and zakah costs that were paid, the actual cash payments here. So what they did at the top was they've adjusted for these items by adding them back, and then below they've reduced them. So our actual cash flow from operations, our actual cash flow that SABIC was able to generate within 2020 was 22 billion riyal versus that 3 billion, 3.3 billion, I should say, of net income, quote unquote net income, right? Or earnings before taxes. Now, this is a very big disparity. I don't know about you, but that's about what, 17 and a half, 18, just shy of 18 billion riyal in difference. So you can see that the income, the income statement profitability, the earnings on the income statement aren't exactly true, because a lot of these items were just non-cash, right? We had 12 billion of this that reduced our net cash from operating activities of depreciation. Now, depreciation is non-cash. So I don't know about you, but I would rather focus on this number here rather than this number up here. Now, moving on to the other activities, we can see that SABIC has spent 13 or 14 billion riyal here in their investments through purchasing additional property and equipment, maybe maintaining their property and equipment, and making some investments in their joint ventures, in their associates and other joint ventures. So this is great. This is what I would want to see. And then finally, they have some financing activities of negative, right? A negative net financing, net cash in financing activities. And this is because they're borrowing and paying off some debt, and they're paying some dividends to their shareholders, which is wonderful. But you can see here that the actual change in cash that SABIC experienced, or the actual cash that they have outstanding at the end of the year, is significantly higher than what we thought earnings was at the beginning. Additionally, more importantly, the operating activities, the cash from the operations, is significantly higher than what the income statement presented. So if this doesn't highlight the importance of the cash flow statement, if this doesn't identify to you, doesn't make you immediately realize why the cash flow statement is so much more important than the income statement or the balance sheet, I don't know what else to try to prove it to you, right? But that's okay. I think most people are getting it. Yeah. How are you guys? What are you guys thinking? Does it make sense? Does this make sense? If you were one of the members who voted for the income statement or the balance sheet, can you let us know? Are you now convinced or not? Go ahead, give us a thumbs up, send a message, whatever you want to do. I see a hand up. Great. Okay. Good. I'm seeing hands coming up. Wonderful. Great. So let us continue. Let us go ahead and continue. Let's talk about the cash-rich standard. So what am I talking about when I'm talking about the cash-rich standard? Well, I have rules that I want to follow, that I want to see when I'm looking at a company's cash flows. Okay? I'm sorry, can you guys hear me or no? Can you hear me? Okay, it seems that we're having a little bit of problem. Okay, cool. It seems one of our teammates actually has had a problem. Okay, good. I think they're taken care of. Okay, so let's talk about the cash-rich standard. So what I'm talking about here is what I, as an investor, as an analyst, as a business owner, what I would want to see when I'm looking at or reviewing a company's cash flows. So the first thing I think is pretty obvious, right? The first thing I want to see is a big positive cash flow from operations, right? I think we can all agree that based on our previous discussions, this is probably the most important thing to see when we're analyzing a company, right? Why? Because when I look at my cash flow from operations, I need to make sure that I'm generating enough cash from my actual business to expand, through investing in my business, buying more facilities, buying more machines, equipment, and also I want to be able to pay my shareholders a little bit of money. I want to give them a dividend, right? They want a dividend. They're not investing just to to be for the sake of it. Investors demand a return. They require a return. So when I'm looking at the cash flow statement, I want to make sure that the operating cash flows is as fat as possible. I want the biggest plus I can get, because I have to pay for my investments. I have to maintain my equipment. I have to maintain my machinery. I have to expand my fleet. I have to do a lot of things to keep this business running, right? When you buy a car, you don't just buy the car and forget about it, right? You have to maintain your car. You have to pay for what? Oil changes, your brakes, your tires, all of these things must be accounted for. They have to be calculated within your budget when you are planning to purchase a car, right? That's why whenever I don't know about you, but when I'm looking to buy a car, I try to figure out what is the maintenance expense going to be for this vehicle. Is it going to be a lot more than my payments on the car, or what's going on there? So these things need to be taken into account. Okay, and then finally, I also want a minus figure for my net cash from financing, because I want to pay back my debts. I want to pay, and I also want to pay my shareholders some dividend. I want to pay them something. I want to keep them happy. So this is the cash-rich standard. I want to see a big plus and a minus, at least a minus enough to maintain my equipment, to maintain my machinery if they're not planning to expand, right? And then finally, I want to see the company paying back debt. I want to see them pay their debts. I want to see them pay shareholders some sort of dividend, right? Now, from time to time, and I want to make this clear. Now, from time to time, this standard will not hold true. Sometimes cash flow from operations will become negative, and cash flow from investing will become positive, and cash flow from financing will be positive, right? This happens. Companies go through cycles, and I see that somebody is sending us a message and they're highlighting that this is only in a stable company. This is in a mature company, right? Oh, yeah, absolutely, not in a startup. Now, the difference within a matured company and a startup, and even a company going through some sort of economic distress, is that these rules that we're presenting here will not be consistent. Okay, so let's just talk about a company in distress before we talk about the startup. A company that may be going through some weakness may have a negative cash flow from operations, right? This happened to a lot of companies last year when this pandemic, which is still upon us, came into effect, right? The airlines were devastated. They had very negative operating cash flows. They were not making any money, right? They were booking no flights, essentially, and they still had these large salaries to pay. So their operating activities were negative, but they were able, the majority of them, at least I believe the majority of them were, able to get some sort of financing, some sort of additional funding. So if you look back a year, the net cash flow from operations was a negative. The investing was, it doesn't really matter right now whether it was positive or negative, but it was probably still a little bit negative, if not positive, because the businesses were probably trying to sell some of their assets to fund their operations, right? Because now this has become negative. But their financing activities became very positive because they were getting some borrowing. They were borrowing money. They were getting investors to come in and help them. So again, these rules do flip from time to time depending on the situation. But now let's talk about startups. Startups have a completely different cash-rich standard, if you will. Their rules are completely different. So for the beginning stages of the startup, they will have negative operating cash flows, negative operating activities every single month, maybe even for a few years. And their investments will continue to be negative because they're trying to grow the business, right? They're trying to invest in the business. They want to reach the capacity that they're hoping to reach. They want to reach the countries that they're trying to expand to, and so on. And then finally, they will be funded through financing. Whether it's probably, if it's a startup, it's going to be through equity, through investors, through venture capitalists, through angel investors, through private equity firms, right? Through your friends, family, your friends and family, right? But there is a point where this does revert, and it does flip back to what the cash-rich standard here presented is presenting. Eventually, that company will reach a phase, the startup, where its operating activities are positive, its investing activities is going to be negative, and its financing activities will finally be negative. So yes, very good point. This does have more to do with larger, more stable, more mature companies. Startups are different. They are actually flipped, but eventually that startup will reach a phase where the cash-rich standard flips back. Okay, so very good, very good. So we are almost out of time. We have a few more things I want to talk about. So let's just wrap these few things up. Let's talk about understanding a company's cash flows. So if I'm looking at the company's cash flows, the first thing I want to do is determine if the company's cash flows are consistent with the rules we presented. Plus, minus, right? If not, I want to understand why. Is the company growing? Is the company in financial distress? What is going on? Second, I want to understand the moves in cash flow from investing and cash flow from financing. How much is the company spending on its investments? How much is it trying to grow? Does it make sense? Are they selling assets? What's happening? And then financing activities. I want to see that they're paying dividends. I want to see that they're not borrowing too much. And if they are, why are they borrowing? What is happening? Are they borrowing in order to pay for their investments? If so, maybe it's a long-term loan that they want to pay back later. I don't know. You'll have to understand the movements. And then finally, I want to determine where my cash came from, either this year through this year's operations or from my prior cash reserves, basically the cash I had at the end of last year. So the cash my year started with. So by looking at that, I can determine if the company is making cash or spending cash, right? So let's go ahead. Now, we're not going to have time, unfortunately, for changes in working capital, although it is an extremely important component of the cash flows, arguably the most important piece of our cash flow from operations, I should say. But I just want to highlight one more thing, and I want to ask you one question. So what makes cash flows so important? Why are we here? Why are we talking about cash flows being so important, right? Well, the cash flow statement is so important because we need to know what our cash inflows, well, for one, where our cash is coming from and where it's going. Because we need to be able to pay our expenses. We have to pay salaries, we have to pay rent, utilities, we have to pay for our equipment, we have to pay down our debt, which is extremely important. The bank does not take IOUs, right? They want cash. Next, we have to make investments. We have to invest in our assets. If we want the business to continue to operate as is, if we want it to continue to grow, we need to make investments. Yes, the presentation will be shared with you, no worries. And then finally, we need to be able to value the business. we value the business using something called intrinsic value. When we perform an intrinsic value in a business, we focus on the company's cash flows, not the company's sales. Right? Sales are important, but cash flows, positive cash flows, are even more important, right? Most of us are not going to be spending money on a money-losing or cash-losing company because we'll never see our money come back, right? So this is what makes cash flow so important. Before we wrap up, I want to ask you guys one more question. I do have one more poll. I'm just curious to see what your responses are, okay? So what other activities would be included on the cash flow statement? Which of these three activities would you see on the face of the cash flow statement? Okay, I see the answers are coming in. Okay, this one was a little bit of a tough one. Granted, it was a little bit tougher, but I think most people are getting it. I think the majority of people are getting it. So let's just go for 10 more seconds, yeah? All right. And we will stop. Okay, all right. Well, it looks like most people, the majority has actually gotten the right answer, and that is to pay dividends, okay? So within our cash flow statement, if you recall, executive salaries are not going to show up on the face of the statement, right? They're embedded within the statement, of course, but they're going to be actually on the face of they're going to be embedded within our income statement. They're not going to be on the face anywhere. Our executive salaries will be embedded within our operating expenses. Now, value of the company, that doesn't show up anywhere. The value of the company is not presented on any of the financial statements. It is the investors or the person who's viewing the statements to determine what the value of the company is. Now we have the net asset value, which is the equity value of the company. But that is presented on the balance sheet, not the cash flow statement. So the only item that's actually presented on the face of the statement is dividends. If you recall looking at SABIC's financial statements, we had one item called dividends to shareholders. This shows up on the cash flow from financing because remember, we want to pay shareholders some money. We want to keep them happy. We don't want them to revolt, right? So that's basically what we're looking at. Now, guys, we had a few other topics to talk about, but unfortunately, we ran out of time. But that's okay because this presentation will be shared with you. So to wrap up, have we all agreed that the cash flow statement is the most important statement, or do we have any holders who still believe that the income statement or balance sheet are more important? We have no holdouts, right? Wonderful. I hope that I was able to prove to you why the cash flow statement, or at least convince you why the cash flow statement is the most important statement. If I haven't, we can talk later. Again, my name is Faritz. This was Virginia Webinars. We offer courses within finance, accounting, valuations, financial modeling, data analytics, Power BI, Power Query, project management, business analytics, business and data analytics, and everything far in between. Please take a look at our website. Take a look at, you can visit us at biftraining.com. We have all of our previous webinars. We have all of our upcoming webinars there, and this recording will be presented there. If you have any questions, please don't be shy. Send us an email. Even if you have a question, maybe you think about later that you weren't able, that you maybe didn't come up now, feel free to reach out to us. You can find my bio. You can find my where to reach me on our website in the bio section. But otherwise, I hope you guys have enjoyed this webinar. This was Virginia Webinar, The Significance of Cash Flows. And I hope to hear from you guys soon. Thank you guys for attending. Have a good one.